Crown Holdings, ticker symbol CCK, just released their Q2 2026 earnings. And, I mean, the numbers are just massive.
Yeah, they really are.
We're looking at Q2 net sales hitting $3.668 billion. Adjusted diluted earnings per share jumped 16% to 2.49. And management actually went ahead and raised their full-year EPS guidance up to a range of 8.3 to 8.50.
Which, in this specific macroeconomic environment is a huge signal of confidence.
Exactly. So today we are doing a deep dive into this official July 20th news release. We have got the raw financial statements, the management commentary, the forward-looking guidance all on the table. And our mission here is to unpack what these highly specific financial results reveal about the broader world.
Right, because Crown Holdings is a leading global supplier of rigid packaging products. And whether you are an investor looking for market signals in a volatile year, or you are just someone who, drinks beverages out of cans and is intensely curious about the economics behind that supply chain, there are massive takeaways here.
Yeah, we are going to explore global consumer trends, some pretty brutal inflation strategies, and how a massive physical manufacturing company navigates geopolitics in 2026.
When you look at a company like Crown, you are looking at a bellwether for the global consumer. I mean, if people are buying canned food or shipping industrial goods, Crown sees those transactions first.
They are the leading edge of the physical economy.
Precisely. Their financial health acts as this early warning system, or I guess in this case, a validation system for the underlying physical market.
So let's get right into those headline numbers we mentioned at the top, because the sheer volume of cash these products generated in the second quarter is kind of staggering.
It really is.
Q2 net sales hitting $3.668 billion. That is up over $500 million from $3.149 billion in the exact same quarter last year, 2025.
Which is a very healthy jump for a mature industrial company.
Right. And net income attributable to the company reached $245 million. But the metric that caught my eye first, the one we opened with, was that earnings per share.
The 2.49.
Yeah, the report says adjusted diluted earnings per share jumped 16% to 2.49. Now, before we go any further into the weeds here, we need to translate that for you, the listener. What does diluted actually mean in plain English when we talk about EPS?
It's a crucial distinction, actually. So basic earnings per share simply divides the company's profit by the number of shares currently being traded on the open market.
Simple enough.
Right. But diluted earnings per share acts like a financial stress test. It calculates what the profit per share would be if every single convertible bond, every employee stock option, and every warrant out there were suddenly turned into active stock.
Oh, I see. So it assumes a worst-case scenario for the current shareholders.
Exactly. It looks at a scenario where the pie is cut into the absolute maximum number of slices possible.
So it's the more conservative, honest number. It's basically telling investors, look, even if everyone cashes in their chips tomorrow, your piece of the profit is still 2.49, which is 16% higher than last year.
That is the perfect way to look at it. It shows genuine structural bottom line growth.
Okay, but the real mystery to me is how they achieved that massive top-line revenue jump. The report explicitly credits three factors for that growth. First, higher global beverage can shipments. People simply bought more cans.
Right, straightforward volume growth.
Yeah. And second, a favorable foreign currency translation of $32 million. But the third factor, this one stopped me in my tracks, they cite a pass-through of $395 million in higher material costs.
Just in the second quarter alone.
Right. And if you look at their 6-month results, that pass-through number is $629 million.
Yeah, that term pass-through, that is the skeleton key to understanding this entire earnings report.
Break that down for me because it sounds crazy.
So in corporate finance, a pass-through means the cost of your raw materials, in this case raw aluminum and other manufacturing inputs, went up dramatically, usually due to inflation or, supply chain friction.
And normally when costs spike like that, a company's profit margins get squeezed. They eat the cost.
Exactly. But Crown didn't eat that cost. They utilized their contracts to hand that exact $395 million bill directly over to their customers.
The beverage brands.
The beverage brands. They passed it right through.
I struggle to see how they pull that off without absolutely destroying demand for their product.
Yeah.
If I try to picture this in a normal consumer setting, it would be like a neighborhood restaurant where the cost of beef and vegetables just skyrockets.
Right.
So the owner crosses out the prices on the menu, raises everything by 20%, and somehow they don't lose a single diner. The place just remains packed every single night.
It sounds impossible when you put it like that.
It does. How is a packaging company able to force nearly $400 million in surprise costs onto its buyers in a single quarter without those buyers just walking away?
Well, the mechanism protecting them is extreme pricing power. And pricing power only really exists when your product is absolutely non-negotiable.
Meaning they have no other choice.
Exactly. Think about it. If you are a global beverage brand, like a huge soda company or a beer manufacturer, you physically cannot sell your product without a container. The packaging is literally just as essential as the liquid inside.
I mean, you can't just pour soda into someone's hands at the grocery store.
You can't. And furthermore, the barrier to switching packaging suppliers or suddenly redesigning your entire factory line to move away from metal entirely, it's incredibly high. It takes years and massive capital investment.
So they're locked in.
Very much so. The relationship functions somewhat similarly to an adjustable rate mortgage.
Okay, how so?
Well, with a fixed mortgage, the bank takes the risk of interest rates changing, right? But with an adjustable rate, the risk of the macro environment shifts from the bank directly to the homeowner.
Ah, I see.
Yeah, so Crown's contracts are structured so that the raw material volatility risk is completely shifted to the beverage brands. When aluminum prices spike on the global commodities exchange, Crown simply triggers the clause, and the beverage brand pays the difference.
Which protects Crown's bottom line beautifully. I mean, it explains how their income from operations still managed to grow from $391 million in Q2 2025 to $464 million this quarter.
Exactly. They didn't just survive an inflationary spike, they structurally bypassed it.
But protecting your margins only matters if people are still actually buying what you're selling. Did passing on nearly $400 million in costs cool off their actual physical sales volume?
The data shows the exact opposite, actually. Global beverage can volumes increased by 5%.
Wow, a 5% increase in physical units shipped is massive at this scale.
It really is.
But looking at the report, the regional split isn't uniform at all. It details double-digit gains in Asia. They saw a 7% increase in Europe and a 5% increase in North America. And management noted that these strong numbers managed to more than offset softer demand in Latin America.
Right, and that geographic breakdown highlights exactly where the emerging consumer class is rapidly adopting packaged beverages.
So Asia is leading the charge.
By far. Seeing 5 to 7% volume growth in highly saturated mature markets like North America and Europe is robust. But double-digit growth in Asia indicates a structural change in daily consumption habits.
CEO Timothy J. Donahue provided some very direct commentary on why this is happening. He stated that global beverage can demand is thriving because customers and consumers alike increasingly prefer aluminum cans.
Yeah, he leaned heavily into that.
He did. He specifically called it the most sustainable and responsible beverage packaging option and noted it's become the go-to choice for new product introductions in both alcoholic and non-alcoholic segments.
Which is absolutely true. We are witnessing a structural shift in how new beverages are brought to market right now.
Like what?
Just look at the explosion of hard seltzers, ready-to-drink cocktails, craft sodas, energy drinks over the last few years. Brands are just defaulting to aluminum instead of plastic or glass.
I have to challenge this narrative slightly, though, because there is a glaring irony here to me.
Okay, what's that?
Usually, when we talk about companies experiencing unyielding, global, multi-billion-dollar demand, we expect the growth engine to be cutting-edge technology. We expect it to be artificial intelligence or next-generation microchips or, advanced software. But here, the explosive growth engine is a 20th century staple. It's the aluminum can. So I have to wonder, is this whole sustainability angle just incredibly effective corporate marketing by Crown and their partners? Or is a fundamental shift actually occurring in consumer psychology?
Well, the financial data in this report suggests it is much more than just a marketing campaign. Whether you personally view sustainability as a fleeting trend or a genuine ecological imperative, that 5% hard volume growth proves the physical market is actively shifting its purchase orders.
Putting their money where their mouth is.
Exactly.
Right.
And the mechanism behind this shift is the fundamental difference between how plastic and aluminum degrade.
Okay, break that down for me. Because to the average person, recycled is recycled, isn't it?
Not at a molecular level, no. When you recycle a plastic bottle, the polymers actually degrade during the process. It's often downcycled into a lower quality plastic like synthetic fibers for a fleece jacket or plastic lumber for park benches.
So it doesn't just become a new bottle?
Rarely. It rarely becomes another food-grade plastic bottle. It has a finite lifespan before it ultimately ends up in a landfill.
And aluminum.
Aluminum, however, is infinitely recyclable. You can melt down a can and turn it into a brand new, identical can indefinitely without any loss of quality whatsoever.
Wow. Okay. So consumers might not know the exact molecular science, but they are increasingly rejecting single-use plastics.
Right, and municipalities are passing strict mandates against plastic waste too. So the psychology has shifted, and this multi-billion-dollar supply chain is actively reorienting to match it.
So when Donahue says cans are the ideal package for brands, that statement is backed by literally billions of dollars in executed contracts.
Right.
Okay, so they have immense pricing power. They are riding a global wave of demand driven by the unique physical properties of aluminum, and they are generating cash at a breathtaking pace.
Which brings us to the capital allocation.
Yes, this is what I consider the most dramatic part of this entire earnings release. What is Crown Holdings actually doing with all this money?
We are looking at a classic corporate balancing act here. They are forced to decide between reinvesting in their future physical footprint and rewarding their current shareholders.
Let's lay out the sheer amount of cash we are talking about first. They expect to generate at least $900 million in adjusted free cash flow for the full year 2026.
That's a massive number.
It is. And just to be perfectly clear for anyone listening, free cash flow isn't just revenue. That is the money left over after paying all the operating expenses, taxes, and maintaining their current factories, right?
Right. It is pure discretionary capital. It's the financial lifeblood of a company.
And what are they doing with that $900 million? They are buying back their own stock at a blistering rate.
Oh, absolutely blistering.
They spent $305 million on share repurchases in the second quarter alone, over $500 million in the first 6 months of the year. The report highlights a staggering statistic here. They have bought back almost 7% of their outstanding company shares over the previous 12 months.
That's wild.
They took 7% of the entire company off the public market in a single year.
To really understand the magnitude of that, we need to look at how a share buyback mathematically impacts the remaining investors.
Yeah, please do. I always hear buybacks described as a good thing, but how does the mechanism actually create value if the company isn't fundamentally changing what it produces?
Okay, imagine a company's total profit is a giant pizza,
Okay, I like pizza.
and the outstanding shares are the slices. If you own one slice, you get a certain amount of the profit. When a company initiates a massive buyback, they are using their own cash to buy slices back from the market and literally destroy them.
Wait, destroy them.
Yes, retire them permanently. So the overall size of the pizza, the company's total profit, doesn't change. But now, that exact same pizza is cut into fewer slices.
Ah, I see.
Automatically, without the company having to sell a single extra can of soda, every remaining slice becomes larger and more valuable. This directly boosts that earnings per share metric we discussed earlier.
Because the denominator gets smaller. The earnings are divided by, say, 93 shares instead of 100 shares.
Precisely. It is a very aggressive lever to return value to shareholders.
Okay, but let's look at the other side of their ledger, the physical reinvestment. Their capital spending is projected at approximately $550 million for 2026.
Right, the CapEx.
Yeah, they are funding capacity expansion projects in Brazil, Greece, and Spain. And crucially, they are constructing a brand new, state-of-the-art facility in northern India. The report explicitly notes this marks Crown's entry into one of the world's fastest-growing beverage markets.
Which is incredibly strategic. Planting a physical flag in northern India exposes them to massive demographic tailwinds. A growing middle class in a hot climate translates to a rapidly escalating demand for packaged beverages.
But here's where I see a major contradiction in their strategy.
Okay, let's hear it.
If emerging markets like northern India and Asia generally, where they just posted those double-digit gains, are growing so incredibly fast, why is management spending $500 million in 6 months buying back their own stock?
It's a fair question.
Right. If the demand is that ravenous, why not take that $500 million and build twice as many factories in India? Or expand aggressively into 3 new countries?
It is the ultimate capital allocation dilemma. But the answer to why they aren't forced to choose between the two, why they can do both, lies in their balance sheet.
Okay.
The report highlights a specific metric right at the top. Their net leverage ratio sits at 2.5 times adjusted EBITDA.
Now, we promise to avoid deep financial jargon where possible, so we have to unpack EBITDA.
Fair enough. EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
That sounds like a lot of jargon.
It does sound complicated, but it's really just a measure of a company's raw operating cash flow before the accountants and the tax authorities get involved. It's the pure cash generated by making and selling cans.
Okay, so what does a net leverage ratio of 2.5 times actually tell us about their health?
It compares their total debt to that raw operating cash flow. It basically means if they used every penny of their raw earnings, it would take them 2.5 years to pay off all their debt.
Which doesn't sound too bad.
In the world of mature, heavy industrial manufacturing, where you have to build multi-million-dollar factories and buy massive, heavy machinery, a ratio of 2.5 is considered remarkably healthy and conservative.
So they aren't overextended at all.
Not at all. Because they have that conservative debt profile and that $900 million in expected free cash flow, they don't have to make the hard choice.
They can do both.
They can fund the necessary expansion in India, keep their European facilities upgraded, and still have enough excess capital to retire 7% of their shares.
And retiring that much stock sends a very specific message to the market, right?
Oh, absolutely. It communicates absolute, unwavering confidence from management that their stock is currently undervalued. If management believed the stock was overpriced, they would hoard the cash. By buying it up, they are effectively declaring the best, safest investment we can make right now is in our own company.
They're funding global expansion while ruthlessly optimizing the value of the shares that remain. It's impressive.
It really is.
But, to get an objective picture of this earnings report, we have to step out of the beverage aisle for a minute.
Right.
We have focused heavily on the glossy, highly successful aluminum can side of the business. But not every segment is growing at double digits.
No, Crown Holdings is a diversified packaging company. Their non-beverage segments offer a sobering window into entirely different sectors of the global economy.
Let's look at their transit packaging segment. This division posted $537 million in Q2 net sales. And management noted that it performed well, but they qualified it with a very specific cautious phrase.
Yeah, they did.
They said it performed well despite a continuing tepid global industrial production environment.
That word tepid carries an enormous amount of macroeconomic weight.
It's a very deliberate word choice.
It is, because transit packaging isn't consumer-facing at all. It involves the heavy-duty materials used to secure and protect industrial goods during shipping.
Like what kind of materials?
We are talking steel strapping, heavy protective films, industrial edge protectors.
So if a company is shipping, say, a massive generator or pallets of construction materials, they use Crown's transit packaging to secure it to the freight train or the cargo ship.
Yes, exactly. So when management describes industrial production as tepid, they are signaling that factories worldwide are not churning out durable goods, heavy machinery, or construction materials at a robust rate right now.
And what's driving that slowdown?
The underlying mechanism here is likely the interest rate environment. When global interest rates are high, borrowing money becomes extremely expensive. Companies delay building new factories, purchasing heavy equipment, or undertaking massive capital projects. That slows down the entire industrial supply chain.
Wow. So while everyday consumers are still happily buying energy drinks and craft sodas, regardless of interest rates, the heavy industrial gears of the global economy are grinding a bit slowly right now.
Exactly. Though the report does mention robust results in their North American tin plate businesses, which includes food cans and aerosol cans.
Right, so the consumer staple side is holding up across the board, even if heavy industry is dragging.
Which brings us to the future. We also have to evaluate the cautionary note regarding forward-looking statements section of the release.
Like the lawyers.
A lawyer section, yes. But it is incredibly revealing because this is where the company is legally obligated to list the macro risks they are actively monitoring. It outlines their exact vulnerabilities.
And they list some big ones. They specifically call out the ongoing Middle East conflict and its potential impact on supply chains. They flag the future impact of inflation, the potential for higher interest rates, fluctuating energy and transportation prices, and the risk of tariffs and retaliatory trade measures.
And none of those are abstract fears for a company like this.
No.
Smelting aluminum is an incredibly energy-intensive process. If global energy prices spike, their costs skyrocket. Geopolitical conflicts in the Middle East disrupt critical shipping lanes like the Red Sea and the Suez Canal, which drives up transportation costs and delays the delivery of raw materials.
Right, and tariffs on imported metals could instantly upend their pricing structures.
Exactly. Operating a sprawling physical manufacturing footprint across multiple continents is incredibly precarious.
I keep picturing their current situation like this, right? Crown Holdings is driving a highly engineered, incredibly capable luxury off-road vehicle. Inside the cabin, everything is pristine. They're passing through costs, the balance sheet is healthy, the cash is just flowing. But outside, they are navigating a completely muddy, unpredictable swamp.
I like that analogy.
The industrial environment is tepid, energy prices are a wild card, and geopolitical potholes are everywhere. The question for any investor looking at this is, how long can the four-wheel drive keep them moving before the mud finally stops the vehicle?
That is the fundamental tension of evaluating industrial stocks right now. However, the ultimate takeaway from this report is how management answered that exact question regarding the mud.
Right.
Despite legally acknowledging every single one of those geopolitical and macroeconomic potholes, what did they do with their financial guidance for the rest of the year?
They raised it.
They raised it.
They bumped their adjusted diluted EPS guidance up from a previous range of 7.9 to 8.03 up to a new, higher range of 8.3 to 8.50.
And that raised guidance is management explicitly stating they believe their vehicle is equipped for the swamp.
They are not worried about the mud.
Not right now. They believe their contractual pricing power, that unique ability to pass through raw material costs, combined with their geographic diversification in places like India and Asia, insulates them enough to weather these specific storms and still deliver record profitability to their shareholders.
It is a bold, highly confident stance. But, the hard data from the second quarter certainly backs it up.
It does.
Let's zoom out and summarize what we've unpacked today. Crown Holdings is having a stellar 2026. They have raised their full-year guidance and demonstrated incredible pricing power, successfully handing off nearly $400 million in surprise costs to their buyers in a single quarter without killing demand for their products.
They are aggressively capitalizing on a global structural shift in consumer psychology towards sustainable, infinitely recyclable aluminum packaging, which is driving tangible volume growth across major global markets.
And they are using the massive free cash flow generated by that physical demand to execute a staggering share buyback program.
Retiring 7% of their shares in just 12 months.
Unbelievable. While simultaneously funding strategic physical factories in high-growth demographic centers like northern India, it really is a masterclass in leveraging a conservative balance sheet to navigate inflation while positioning for long-term trends.
It reveals exactly how a well-positioned physical asset can thrive even in a tepid macro environment.
Before we wrap up, I want to leave you, the listener, with a final provocative thought to ponder on your own.
Let's hear it.
We spent a lot of time today exploring the transition from plastic to aluminum as a massive sustainability win. But think about the physical weight and the sheer logistics of a world where plastic is systematically and entirely replaced by metal.
Right, because aluminum is heavier than thin plastic.
Exactly. It's heavier, it's dense in transit. It requires entirely different handling mechanisms on shipping pallets.
That's a huge shift for the supply chain.
It is. If aluminum cans continue to dominate new beverage launches globally, as CEO Donahue suggests, how will the global shipping industry, municipal recycling fleets, and even the stock boys at your local grocery store have to adapt to a world packaged entirely in metal?
It changes the entire physical infrastructure.
It absolutely does. The next time you pop a tab on a cold drink, take a second to consider the multi-billion-dollar, globe-spanning, highly calculated supply chain that just delivered that simple aluminum can into your hand. That's all for today's deep dive. Make sure to follow the show for our daily earnings coverage, and we will catch you on the next one.